In this video you'll not only learn what intrinsic value is, but you will also learn how to apply it to help strengthen your research when looking for the perfect stock to buy. Being able to calculate intrinsic value will allow an investor to not only find what a fair value is for the stock they are wanting to buy, but also allow the investor to know how over or undervalued the stock is. Intrinsic value is defined as a measure of what an asset is worth that is arrived at by means of an objective calculation or complex financial model rather than using the currently trading market price of that asset, according to Investopedia. In simple terms, it's the true value of a stock. The catch here is that there is not one single intrinsic model or calculation for all stocks. Every stock is different and should be calculated as such. Some have dividends, some are growth stocks, others are value stocks, each of which requires a different intrinsic value formula. The most common formulas used are the dividend discount model, Benjamin Graham's formula, and the most commonly used discounted cash flow analysis. The discounted cash flow analysis is calculated as so. Intrinsic value equals expected cash flow divided by 1 plus required rate of return to the nth period. This formula can be used on all different time frames depending on one's outlook. This means that you can plug in statistics based on estimates for the next few quarters, or the next few years if you want. For example, if you want to find out if Apple is a good buy using the discounted cash flow analysis, you can use either your own predictions or analysts' predictions to plug into the formula. For this case we'll use our own predictions for Apple's cash flow, and analysts' prediction for required rate of return. You can see that in Apple's cash flow statement, their cash flows have grown 45% from 2018 through 2021. To keep it simple, we'll estimate that their cash flows will continue to grow at this average, which comes out to 14.37% a year. Because cash flows ended at $92.95 billion in 2021, we can assume that they will end at $106.31 billion in 2022. Between over 30 analysts' predictions, Apple has a median prediction to grow 5.9% next year, but at a rate of 9.48% per year over the next 5 years. To make things simple again, we will use the average rate of 9.48% as our required rate of return over the next 5 years. We will now calculate our cash flow predictions along with our required rate of return over the next 5 years. Now that we have that, we need to close the equation with our terminal value. Terminal value is calculated by using the last estimated cash flow, in this case it's period 5, and then multiplying that by how much we predict the stock will grow in perpetuity. Because we don't think that Apple will grow at nearly 10% over the next 100 years, we'll be modest and assume that the stock continues to grow at 5% per year. We now divide this by our required rate of return minus the perpetuity growth rate. After calculating these values we come up with a terminal value of over 4 trillion. But what if we used Benjamin Graham's model? His model is shown below, where intrinsic value equals earnings per share times current price to earnings ratio, plus 2 times the company's estimated 7 to 10 year growth rate. Graham's formula is not meant to be used on growth stocks but is more geared towards value stocks in blue chips such as Bank of America, Wells Fargo, or Berkshire Hathaway. Apple seems to be more in between a value stock and a growth stock, but Benjamin Graham's model's 2x growth rate is very aggressive for value stocks, and can be lowered down quite a bit as wanted. Since Apple is not quite a value stock, we'll keep this 2x growth rate for this example. Apple's 12-month earnings per share currently sits at 6.05, price to earnings ratio sits at 22.84, and we predict its 7 to 10 year growth rate will stay at the same 9.48%. After doing some math, the Benjamin Graham's intrinsic value comes out to $139.33 per share. That's almost dead on from where it's currently at, suggesting that Apple is trading near its true value. But Benjamin Graham later created a revised version of this equation where he added the average yield of AAA corporate bonds, then divided this entire equation by the current yield of AAA corporate bonds. Given this equation, Apple's stock is predicted to be valued a bit less at $131.84 per share. But what if we use this formula for a value stock as it was intended? Let's use Bank of America for example. Bank of America currently has an EPS of 3.2 and a 9.44 PE. So both equations will look something like this. You can see that the valuation is fairly close, just as it was with Apple. Whether or not that these stocks are near their true value or not is discretionary. The next formula we have for finding out a stock's intrinsic value is the dividend discount model. This model is considered to be the most accurate for dividend-paying stocks, hence the name. Although if a growth stock is paying out dividends, you may want to compare this formula with another formula that better suits a growth stock, because this formula does not take a company's current or future growth rate into account. The formula is as follows. EDPS stands for expected dividends per share over the next year. CCE stands for cost of capital equity, also known as discount rate, or the rate of return required by investors. And DGR stands for dividend growth rate. We'll use both Wells Fargo and a higher dividend-yielding stock such as Simon Property Group. As you can see, the stock with a sub 3% dividend yield was said to be overpriced, but the stock with a dividend yield of nearly 8% was said to be trading at a huge discount. The last intrinsic value formula we will cover is used for options. Out-of-the-money contracts have zero intrinsic value by nature because they are already trading above the stock price if you are buying a call, or below if you are buying a put. That's why out-of-the-money contracts are considered to be more speculative, and therefore, more risky. However, in the money contracts have intrinsic value. Here are the formulas if you were to buy a call or put. You can see that because buying a call is a bullish position, you must subtract the strike price from the current stock price, and vice versa for a put, since a put is a bearish position. For example, if a stock is trading at $10 a share, and one buys a call with a $9 strike, the option has an intrinsic value of $1. Although typically a call option in this scenario won't be trading at exactly $1 per contract, and will carry additional extrinsic value due to other varying factors such as volatility, time till expiration, etc. If you enjoy our content, don't forget to like this video and subscribe to our channel to stay up to date with market news. Thanks for watching and stay informed.